know people are coming back after a short break here, and before we pass off to Alex, kind of tying the threads together here. We started with myself giving an overview of kind of crypto and blockchain and just how to make sense of the asset class, and then moved into kind of consolidated trading through James and how to pull it all together and some of the trends that have happened in custody, and then kind of moved back out to broader reporting of assets, which sometimes you get so focused on the asset you forget about the administrivia of keeping track of it in your own books and accounting, whether it's for allocation reasons, but also for those that trade in the space, like really having that buttoned up, especially with tax authorities and others coming into play. That's where Tanmay comes in. And so now we'll pass it off to Alex, who heads up the shop at Onchain Custodian. And you can take it from here, Alex, and I'll intercept you at the end with some questions, all right?
Absolutely. Thank you. Yes, we're now going into digital asset custody. We did mention a few piece of information before my part on what is custody, and I'll try to deep dive a little bit more in how institutional grade custody works in general, and how at Onchain Custodian we are dealing with it. The purpose being, of course, to ensure that your private keys are safe in a, again, enterprise grade environment. So we've heard this morning that more and more traditional corporates or traditional financial institutions or family offices, high net worth individuals and others are getting into the space of cryptocurrencies, are investing. We know that traditional banks who used to honestly not being very nice with Bitcoin, for example, are changing their mindset because they do know now that this asset class is there to stay. We understand that obviously custody, and we're hearing about PayPal, for example, allowing as well their customers to hold assets. And what all these people have in common is that they are using third-party custodians. They do not manage their assets on their own. They do not leave their assets on exchange because they are familiar with the custodian concept in the traditional capital market space. And they understand that not only for security reasons, but also for third-party auditability and as well as segregation of duties, it is important for an asset manager, for example, to use a third-party custodian. Sometimes it's even mandatory for them to use a third-party custodian. And in the world of cryptocurrencies, it's even more important because the assets are pretty much bearer instruments when you think about it, meaning that if you lose your private keys or misplace your private key, or the exchange where your assets has been hacked, you're losing your assets, as simple as that, and it's not recoverable. It's a bit more recoverable nowadays because exchanges are collaborating with one another when there's a theft, but it's still very complicated. And that's why in 2 to 3 years ago, I would say, yeah, around 3 years ago, 3-4 years ago, the concept of institutional grade custody provider emerged, very much copy-pasted from the global custodian and sub-custodian concept existing in the capital market space for holding bonds and securities and other types of securities. And initially, the purpose was to solve one major challenge that crypto has: the number of hacks and the number of misplacement of private keys that was happening in the industry. When you look at the slide, you will see that about, when I say 5 billion, obviously it depends on the value of the assets at the time of the haste, for example, or misplacement, but more than $5 billion worth of assets have been hacked or misplaced. In the past, it's probably closer to 10 billion, to be honest, and the numbers are not very clear. And it is huge. I mean, when you look at a well-known hack in the world of capital market, which was the Central Bank of Bangladesh, whose SWIFT credential had been compromised, and I know about that story because I used to work for SWIFT. The thief attempted to steal $1 billion worth of US dollars. Actually, they only managed to get away with 60 to 60 million US dollars, which was still a lot of money, but the rest was recuperated from the banks where the money was at the time. The investigation found that money, and they were locked in those banks. That's not happening in crypto. Once the assets left your wallet for the wallet of the hacker, for example, it's pretty much lost, as I shared earlier. So there are quite a few types of custody, ways of custodizing your assets. You could decide to leave it on exchange at the trading platform you're using. You can do self-custody of your assets into hardware devices or a metal card like James mentioned before, or even a paper wallet, as some people were doing initially, or you can use custody services. And as you can see on this checklist, the advantage of using a third-party custody is primarily the focus that third-party custody have on that business of securing digital assets. Exchanges are really not good at it. If you look at the left, most hacks happens on exchange because that's not their core business. Their core business is to intermediate buyers and sellers and make money out of that transaction stream. The custody part, generally, they don't invest enough money in it. They don't invest enough attention to it and focus to it. What custody service providers would do in general, Onchain Custodian and other custodians. Another issue as well is transparency in exchange. All the assets of customers on exchange are generally commingled into one big wallet or a set of wallets that sometimes are online in hot wallets, sometimes called in offline, but generally it's a nice honeypot for hackers, because they know that when they access a hot wallet on an exchange, it's going to be millions and millions and millions of dollars they're going to be able to steal. Custody segregates assets, meaning that when you have your assets with Onchain Custodian, for example, they are segregated by wallets belonging to each individual customer, meaning that a hacker would need to go after multiple wallets and break multiple wallets to be able to steal, to make its efforts worthwhile. On the investor side, as an investor, you can decide to safekeep yourself, you self-custody your assets. Not ideal, because even if you lose all the instructions that are provided with a ledger, for example, in terms of making sure that you safekeep the phrases that will be required to recover a ledger, for example, and so on and so forth, you're still at risk of that ledger defaulting. You're still at risk of losing your assets. And if you are multiple people needing to manage a portfolio of cryptocurrencies, you really don't want to let that power, that control, in the hands of one person only. Again, the advantage of third-party custody is that you can define the level of authorization required to instruct a movement out of the wallet. You can participate in some cases to the signing of the transaction on the blockchain itself, depending on the setup of the custodian. In other words, it's bringing an enterprise-grade level in terms of accessing your wallets and transacting out of your wallets. So how do custodians function? And I think someone is not muted, just to make sure. Yeah. Okay.
There was one question that came in. Do you mind if I ask real quick?
Go ahead.
It's an interesting question about, aside from the hacking, there are succession issues in the case of if I pass away and I haven't told my brother or the executor of my will my private keys, then man, those assets are lost because the password is lost with me. First off, I'm curious your reaction to that. The other question is, can you hold the key as the individual trades and then trade this from part of the estate in death through a will? Or do you have, as a custodian, a way to have a subsequent beneficiary, someone to ask? I'm curious your reaction.
It is a very good point. So hacking and misplacement, I would put that into the misplacement type of category of issues of private keys. Yes, it's definitely one of the reasons using a third party, which is specialized in safekeeping of assets, is important for in case of you get hit by a bus. Let's put it this way. Generally, custodians would function like a bank, meaning that once you die, your assets are not stuck at the bank forever. Someone who has the right over them because they are because it's your wife or it's your kids can unlock those assets after proving that they are the legitimate beneficiary of those assets. And this would be exactly the same for custody. So we would give access to the account to the person or the party or the whoever has proven that he has legitimate right over those assets after someone passed away, for example. So yes, this is clearly a benefit of custody service in general at a third-party custodian. You don't have that as an investor, as a self-custody, obviously, or unless you decide to share your private keys and secrets with your wife. But is it maybe something you would want to do? I'm not sure. It's a choice, I guess. And the trading platforms would generally do the same than custodians in terms of giving access to the next in kind in those situations. But I think it might be less of their specialty in dealing with those matters.
Got it. Well, thank you for asking. Please continue with the next question you were going to address, or next slide.
No worry. I've actually have a nice anecdote on that. I met a whale one of these days. The guy was 25 years old, and he had invested very early stage when he was 16 years old, and he was a billionaire, literally a billionaire. And I asked him, so how do you hold your assets? Well, I have ledgers and I put in a safe. And so, okay, it's an interesting way. And I asked him, he was 25 years old, I asked, what happened if you get hit by a bus? It's as simply as that. And he said, I could see his face becoming blank because as a young 25-year-old guy, you believe you will never die, right? And he didn't even think of that, honestly. He didn't have anybody that would be able to retrieve his assets after he would be hit by a bus. So it's interesting to see how people don't sometimes think about that. And I know that family offices and high net worth individuals are not like that at all. And they generally want to ensure that the wealth of their family is passed on to the rest of the family. And that's something we can help with as well.
Great.
So going to the demand, so in 2 to 3 years ago, and that's why Onchain Custodian was created, we created really something that is enterprise grade, as I shared earlier on, that can give a single window access to all the assets that you've purchased in the crypto space, but also enables transparency and reporting and auditability as well of investments for asset managers, for example, but also for family offices and anybody really needing that transparency. And finally, it's also guaranteeing some level of independence and neutrality, and that applies, for example, for asset managers managing assets from other individuals, so money, clients' assets. It also gives there are also incremental roles that digital asset custodians are taking more and more. For example, managing events. So for blockchains can fork, so a blockchain can be split at one point into another blockchain, and there might be a decision to take about what do you do with the assets. Do you embrace the fork, or do you keep your assets into the historical blockchain? So it's a bit like a split in the stock market. These events needs to be managed. If you have to do it on your own, it's not necessarily easy. We also give access to ways of generating yields around those assets. Also transaction management, lending and borrowing, so pledging your Bitcoin in exchange of a loan, for example. So all those functionalities are now becoming day-to-day business streams of custodians, giving even more reasons to use a third-party custodian. But let's look at custody in particular. There are different ways of storing in a secure way assets at custodian level. So custodians might be using, for example, multi-signature cold storage. In that case, what does it mean? Is that the assets are offline, and once an instruction is sent to the custodian through an authorizer, an authorizing process, a transaction authorization process, the assets will then be unlocked using hardware devices that will be operated on a sequential basis to, as I show on my little animation, unlock the assets. Sorry. So it's pretty simple. It's hardware based. It's offline. The hardware devices are kept into physical safe, and you can be sure that if the operational setup around this setup is done properly, the assets will never be hacked away from those offline wallets. The challenge with cold storage, obviously, is that it's not available 24 hours a day, 7 days a week. It requires human intervention, and when humans are involved, it often means an operational risk that needs to be mitigated. And more importantly, I mean, it's nice for long holders, but it's not very efficient for active traders, for example. That's why you have multiple ways of making available private keys to customers 24 hours a day, 7 days a week that have emerged in the past. You have multi-party computation, and you have HSM-based. I'm going to start with multi-party computation. It's a mathematical way of breaking down a private key into multiple shards that will be recomposed mathematically or algorithmically at the time it needs to sign the transaction. So those keys are generally spread across multiple devices. It can be the devices of the approvers of the transaction. It can be different systems that when a transaction needs to happen, it will call for the charts to get back to the center in a way, and will enable the signing of the transaction at the time it's required. What is interesting as well in the MPC scenario is that once those private keys, once the transaction has been signed, those charts or those are reconfigured, are no longer the same that what they were before the previous operations. Some setup actually renewing the charts every day, making them very complicated to hack. For a hacker, you would need to go in different places, get a hold of enough keys, enough shards to sign a transaction, and do that relatively quickly, because the next day they no longer, whatever you manage to get is no longer usable. So it's quite powerful, and but it's a new type of technology. It's been around for in an institutional level for the last 2 years only, and some people are not comfortable with that type of setup because it's software based most of the time, and it's not. It's a strong technology, but not proven yet. What we are using at Onchain Custodian is hardware security modules. So how does that work? It's actually leveraging on a technology that banks have been using for the last 20 to 30 years. Very robust technology that hasn't been cracked ever, really, because it's built on the concept of hosting in a hardware secure module, as its HSM means, the private keys, but also signing transaction in that environment, and sometimes encrypting the entire operational environment through an HSM. In our case, we're using IBM HSMs. These IBM HSMs are hosted at IBM data centers with all the extra level of security you can imagine. These IBMs are not even accessible. These HSMs, sorry, are not even accessible by IBM themselves. They are only accessible through secured APIs by our setup, by our own setup that we've built around those HSM. It's pretty powerful. Not only does it prevent anybody to get in and get access to the encryption material, private keys, etc., but it also ensures that the for example, the people developing codes cannot on the side develop a specific code to try to get access to that information. It's very robust. So an evil system administrator would not even be able to tamper with those type of HSMs. So that's for the theory and the type of technologies that are being used by custodians around the world and on-chain custodian to secure assets. Now I will finish by explaining a bit how what we do at Onchain Custodian. So Onchain Custodian really is offering, as you can see here, a one-stop shop to secure assets both in cold wallets and in warm wallets. By the way, both cold and warm wallets are insured. So there's an insurance coverage if something goes wrong that covers both types of setups, including employee misconduct. What often other custodians don't have, they generally have an insurance that covers issues with cold wallets. That does not include warm wallet. It does not include employee misconduct. In our case, it's covering the entire scope of custody. We give access to this service directly to clients, so who owns and manage their own assets with us, but also to financial institutions managing assets for other customers, so what we call financial institutions. Beyond wallet services or custody, we offer what we call access to open finance services, meaning that once you have Bitcoin, you can deploy them into asset management products, generating a yield. You can lend your Bitcoin against a yield. You can borrow money using your Bitcoin as collateral. All this through a network of trusted partners that we've built over the years, and that give, in other words, access to liquidity. And we also allow for those customers to buy and sell those Bitcoin, Ethereum, and other assets through our OTC desk. So the idea is to be a one-stop shop for family offices, high net worth individuals, institutions, corporates to manage their assets. For corporates, interesting as well, we're helping corporates execute the treasury strategies, for example, in a cool way, meaning without emotion. They provide us with a strategy, and we execute that strategy based on the price of the assets they have. So sell at one point, buy back at another point, without them being emotional about it, meaning that we are executing as it is the strategy, which helps them manage their treasury in a smart way. The platform looks like this. It's a user-friendly, nice-looking internet-based platform where you log in through multi-factor authentication. You can set up the level of authorizers you want, 1, 2, 3, 4, 5. You have to whitelist the addresses that you send to for cold storage. You can do that for warm storage. So it's really configurable to the level of security you wish and are comfortable with. That's how cold storage works. I'm not going to go into the details of that. And as I shared here, the warm wallet is secured by IBM. And when you look at other providers that today are using HSM as a technology to safekeep private keys and execute transactions and sign transactions, you will see that we are the top in terms of cert security. The IBM's HSMs are FIPS 140-2 level 4 certified, which is the highest level of certification that the FIPS authorities gives to HSMs. The HSMs that Swift, for example, my ex-employer is using for banks to connect to the Swift network are generally level 3. And our competitors as well here are using, when they're using HSM, level 3, level 2 type of security and certification. I will finish by just explaining that the industry is really organizing itself. So beyond being an individual custodian, Onchain Custodian is very active in building the industry of custody to make it reliable for all customers, whatever custodians they choose. So we've created, as part of the Global Digital Finance Group, a custody working group that I'm co-chairing with Hervé François from ING. And our job is to define best practices, market practices, and code of conducts, how custodian in the space of crypto should behave to protect their customers, to ensure they are compliant, to be transparent with the customers that they're working with in terms of level of insurance, in terms of mechanism, operation and technological setup, just to make sure that this industry is becoming what it deserves to be, meaning serious, enterprise grade level, and embraced by more than just the retail investors in the past. Finally, look at the numbers, the people that are part of this custody working group. It's not only about Onchain Custodian, it's not only about security providers like Securosis, who are building HSM actually, or Metaco. It's also traditional banks like DBS, Citibank, BNP Paribas, and so on and so forth. And all these are working together to really build an industry that deserves to grow despite competition among ourselves. I will finish there, and put that important notice as usual that we don't advise on crypto. You buy whatever you believe you should buy. We only safekeeping those assets for you, and we can help you buy and sell, as well as deploy those assets into financial products at your wish. Thank you.
Great. That was very informative, Alex. Thank you. I love nerding out on this stuff because I've been in the space, and so I have a couple questions I'd like to ask while also watching the time, and also want to address any other questions that. Oh, actually, here's one in the chat. Are you regulated as a custodian by Mass in Singapore?
Very good question. So we are regulated in the sense that the Payment Service Act license has been upgraded in 2019, live from 2020, to include digital payment tokens as well as stable coins or e-money as part of a regulated activity. So in that context, we have applied for the PSA license. And while we are applying for the PSA license, we are license exempted, as we were doing business before the license even existed. And that process is still ongoing. At this stage, no license have been given by MAS, who's taking its time, as always, because it's a diligent regulator. But we are regulated by MAS in the sense that we need to follow all the AML-CFT, for example, regulation and notices that MAS is issuing. We need to we're reporting on regular basis to MAS or on our positions on the holdings, etc. So we are de facto regulated. Yes.
Okay, great. I have a question too about kind of how you handle different size accounts. Let's say you got $1 million fund, a $10 million fund, or a $100 million fund. I imagine you may handle the segregation of custody differently, whether it's a single investor family office or a fund. I mean, how do you guys think about that and separating out the risks in the custody?
So it's really in dialogue with the customer. We don't take decision for the customer. We advise them on, for example, if you're holding assets for different underlying or investors, or if you want to segregate per underlying investors, that's absolutely possible, which actually can help in your reporting mechanism back to the investor. If you don't want to do that and hold it in an omnibus wallet, we then advise them to keep and that you are somewhat an active fund, and you need always 24 hours a day, 7 days a week availability of fund, for example, for a portion like 20% of your assets, we would advise, okay, keep 20% in warm wallet and 80% in cold wallet. Some customers are very comfortable with the security that our warm wallet is offering because they understand the HSM technology, they understand all the risk level, they can fine tune in our platform, and they have everything in warm wallets. So it's really depending on how customers are, how comfortable customers are, I would say, with custody in general, with us as a company as well, and really based on their risk appetite, they can hold in different ways.
Okay, great. Thank you for answering that. As you think about the insurance behind it, I mean, that was something early on I'd modeled out, even building a fund for friends in 2017, 18, and I was so worried about the custody side then of, gosh, what if something happened? And then, everything's evolved since then, though, right? And I mean, I was a partner at a long-only listed equity hedge fund the past couple of years, and we were doing normal $1 million, D&O, E&O policy, and it was about, I don't know, $15,000 was the market rate for it. But crypto funds, I asked them, I said, how much for crypto? It was like 5x the price of insurance, and it also didn't cover everything, right? Like it didn't cover price volatility or something like that. How are, because you're interacting with the insurance providers, what are you seeing in that space? How is that evolving? And what do you think is fair pricing for insurance on the custody side?
So first, the way our insurance is mutualized across all customers, okay? And customers have the ability to request their specific assets to be insured specifically under a contract. So just to give you an idea on how it works, in terms of coverage, I think we've worked with insurance companies to ensure that the coverage, in terms of scope of coverage, not necessarily the size, but the scope of coverage would be big, because I think it's important that both warm, cold, and employee misconduct is insured. So that's good. That's progressing in terms of scope. The challenge is still the price, right? The offer and demand, or the availability of insurance companies ready to insure the crypto industry, it remains relatively low. So the price remains quite high, actually. We're talking between 1% and 2% of the value of the assets insured per year, which is quite big. But as a custodian, that's part of the cost of doing business, to be honest. Of course, we factor part of that in the price that we charge our customers, but we can't factor all of it, obviously. So that's part of the cost of doing business. We are in constant dialogue with insurance companies to improve that, to demonstrate that, look, 2 years operations never had an issue. The price should be going down. And it's part of the regular dialogue and negotiation that we need to have with insurance companies. In our case, it's Lloyd's underwriters, Lloyd's of Banks, Lloyd's of London's underwriters, and actually the only insurance companies in the world that are underwriters that are doing that are in London. That's as simple as that.
And I assume the custody working group, that's one of the reasons the consortium is getting together, is if everybody cleans up some of the risks and shares best practices, over time, those insurance costs should go down too for participants.
Absolutely. You're absolutely right. And that's exactly one of the purpose of those type of custody of working groups, right? Industry groups, is to not only lobby the regulators for, but also lobby the insurance companies to really realize that this industry is now enterprise grade, institutional grade, and deserves to have better tariffs in a way.
Got it. Okay, great. Well, I see Hong Fei is here, about ready to hop on. Alex, is there anything else you'd like to close with before we shift?
No, I think I've covered everything, and the previous speakers also did. So I will let the Hong Fei close this event.
Okay, great. Well, thank you very much, Alex.